What I'm going to talk about is obviously what's on everyone's minds. This crisis that we face, or the aftermath of the crisis. So we went through a very, very frightening period, maybe 6 months or so after the fall of Lehman Brothers. And then the extreme period, the terror, receded, and many people said, "Oh, it's all fine now," but it wasn't. And we're actually, in some ways, in a more difficult time than the period of extreme crisis, because it's much harder to get agreement on what should be done. Very easy to let things slide. And so I want to talk about the nature of the problem we have, and the prospects looking forward, which I'm sorry to say I'm not very optimistic about. So let me start with the just a kind of indication of what happened and how far we still have to go. So this is for the three major advanced economies, treating the EU as a single bloc. This is what happened to GDP in the moment of in the crisis and its aftermath. Very severe downturn. Actually, most severe in Japan, which is surprising. Japan did not have a housing bubble. It did not have a financial crisis because they had their bubble and their financial crisis 20 years ago. But they got hit very hard by the decline in world trade and severe slump, followed by rapid growth, but still leaving them below where they were. Actually, Germany looks somewhat similar. Germany also had no bubble, no domestic financial crisis, severe drop in GDP because of loss of exports, fairly rapid bounce back, but still below where it was at the beginning. And as you see here, as of the second quarter of this year, all three major economies still below their production before the crisis began, and of course several years of growth should have taken place. If you try to measure how far we are below trend, the trends were slower in Japan and in Europe than in the U.S. So overall, we're all about equally depressed, and it's bad. I think if we were to make an estimate, the output gap in the United States is probably around $900 billion at an annual rate. That is the difference between what we could be producing if we had full employment and what we're actually producing is about $900 billion a year, roughly equivalent for Europe, smaller for Japan, but altogether $2 trillion or more of waste, of productive capacity not being used, coupled with very high unemployment. In the United States and in Europe, both about 10%. Europe is more accustomed to high unemployment. The U.S. is not. The U.S. safety net is terrible. So the tremendous amount of human suffering in the U.S., not as bad in Europe, but in parts, certainly in Spain, very, very severe hardship. This is not what I'm showing up here. This is not recovery in the normal sense of the word. Technically, it's a recovery. If we ask, has GDP been rising? Yes, the recession is over. But we're nowhere close to having experienced a full recovery. This is not surprising. The history of what happens after financial crises is that they normally have long effects. It takes a long time to recover. So these are unemployment rates in three crises, widely separated in time and space. The blue line is the United States following the panic of 1893, which was the worst financial crisis until the 1930s. Now, if somebody may be informed enough to know that we don't actually have unemployment statistics for 1893, but this is an attempt to estimate based on fragmentary data, and it looks plausible. The red line is Sweden after its 1991 financial crisis. That's real numbers. What you would notice from both of those is, first, a large rise in the unemployment rate, and secondly, persistent. It took a long time for unemployment to come down after the 1893 crisis. Sweden in recent years has been a pretty happy place. Unemployment is fairly low. It's been looking good. And we look back at Sweden and how it handled the 1991 financial crisis, and it's regarded as a success story. They nationalized the weak banks, recapitalized them. They did well in dealing with their banking crisis. But the fact of the matter is it didn't start to look like a good story until years and years after the crisis. Sweden had a really bad employment story through most of the 1990s. And then the United States today, and the United States is more or less tracking exactly what you would expect. As some of us say, the United States is experiencing an average severe financial crisis. That is, the numbers are terrible, but they're terrible in a way that more or less is what you should have expected given this crisis. But unfortunately, if that's true, if history is our guide, then it will take a long time before things are actually okay. So if you look at, is Obama doing badly in running the U.S. economy? Well, no worse than you probably should have expected. But if you think about, when, given the way these things usually work, when should we actually really start to see serious, clear-cut improvement in the unemployment picture? And the answer, as I'd like to say for U.S. audiences, it's sort of late in President Sarah Palin's first term. It's going to be a long time before we really, in other words, we really would not expect to be seeing it until 5 years or so from now before we really feel that this crisis is over.
I have several questions, of course, here, and I would like to put some order to them. Let me try and see whether I understood what's been going on. What's been going on is this. We get a beautiful talk. I should say not often we get talks about the crisis so well organized, so thoughtful, so deep. But the conclusion is, sorry fellas, nothing doing.
Yeah.
Well, let me spend 2 words on that, because you've been telling us that basically there are 2 ways out, 2 avenues out. One is policy and one is entrepreneurship. On the policy side, we have fiscal policy, we have monetary policy, and let's call it climate policy, just to exemplify. Yeah. Now let's start from the top and start from monetary policy, which leads me to the first question, because basically what you've been saying ever since the beginning of this crisis has been, to policymakers, look, you're not doing enough. It isn't enough. You're saying it to the Fed, you're saying it to the government, and up to this date you're absolutely correct. Not enough has been done. In other words, how big is the stimulus, this quantitative easing tool that we are talking about, that you think could be, in the medium-long run, inflationary enough to reactivate this economy?
Okay, so I did not actually talk about quantitative easing. So let's talk about that. So the quantitative, for those, I assume most people know this stuff, but so normally monetary policy takes the form of open market purchases of short-term government debt. And that's what's at its limit. Now, nothing more you can do. At this point, the interest rate on short-term debt is about 0. People, if you do an open market operation, you're just swapping one 0 interest rate asset for another. It does nothing. So actually, there were 2 versions of how monetary policy might get an effect here. One is to announce an inflation target and commit yourself to doing it later on, and which means that what you're basically doing is you're saying that once we're out of this, once the zero lower bound is no longer binding, we're actually going to hold off and let inflation rise thereafter. And that could make people more willing to borrow. That's what I was advocating for Japan 12 years ago. But that's proved to be very, very difficult because you can't, central bankers really hate the idea of promising higher inflation, and they find it really impossible to imagine committing their future, their successors, committing future central bankers to honoring those targets. So that hasn't been going anywhere. So what's on the table is quantitative easing, which is a terrible term, because it really what we really mean is qualitative easing. We mean the Fed or the ECB buying a different kind of assets. Real quantitative easing is what the Bank of Japan did for a while, which is they just stuffed the banks full of reserves, just hoping they would go somewhere, and it didn't happen. So we're talking instead about buying longer-term government debt, right? And that's certainly what the Fed is about to do. If you think it through, I think it's really helpful here to think in terms of the central bank and the finance ministry, so the Fed and the Treasury or whatever, as a consolidated balance sheet. And if you think that through, then what quantitative easing really amounts to is it's actually shortening the maturity of government debt. The Fed creates reserves, which is in effect short-term borrowing, uses those to borrow to buy back a bunch of long-term government debt. So what's really happened is that the consolidated unit has shortened the maturity of its debt. Think about it that way, and you become skeptical that quantitative easing on the scale we're talking about can accomplish that much. $1 trillion of QE by the Fed is equivalent to a 1-year reduction in the maturity of U.S. government debt. That will reduce interest rates probably 15 basis points maybe on the long-term debt. I mean, it's very hard, but we have some evidence from the past, and it suggests a modest impact, but that is really hard to get a lot of traction. So if you try to take this seriously, if you try to, here, since I actually have my pictures, if we actually ask what it would take to close that Taylor rule gap, I'm sorry, I'm really tired, and the more tired I get, the more economics jargon I use. It's typical. But to close that gap, estimates run from $5 to $10 trillion of quantitative easing. So very, very large. In effect, the Fed would have to buy the entire outstanding debt of the U.S. government. There's a case for doing that. I mean, I think actually that they should, but will they do it? I have my doubts.
Okay, so here we have a first answer. The first answer is we need to reflate, right?
Right.
We need to reflate. That's apparent to most people. Can the Fed do it? Well, perhaps we can learn something from the first reaction of the monetary authorities to the crisis, right? I mean, when they reacted first in the fall of 2007, we are seeing these balance sheets ballooning, and at the same time unemployment increasing. So,
well, but that's you have the problem that there are other things happening at the same time. I mean, you have to be a little bit careful. You know, if you look at the correlation, you would basically say that fire departments cause disastrous fires, because whenever you see those sirens coming, that's when the thing burns down. Anyway.
I'm talking about ineffectiveness.
Yeah.
That's
right. It was. No, I actually think that quantitative easing in the crisis was actually more effective than it's likely to be right now, because you had a period of really dysfunctional markets. When nobody is willing to lend and you have extreme disruption, when the commercial paper market has just disappeared, that's when having the central bank buy some commercial paper actually gets quite a lot of traction. But we're not in that situation now. Yeah. It's precisely because the markets are sort of normal that it's very difficult to get leverage now.
Okay, so in the second stage of that crisis, what we saw was a mix of monetary expansion and fiscal expansion of a strange type, right? The US government especially was beginning to purchase